What's going on, everyone, and welcome back to my channel where I help young professionals master their money so they can build their best life. In this week's video, I'm going to explain exactly how beginner investors can outperform 92% of professional money managers. Stick around for the full video where I'll also show you the secret the investing world doesn't want you to know and the big mistake most rookie investors make. Let's get started. What comes to mind when you hear the word investing? Most people respond with confusing, overwhelming, intimidating, scary, risky, or even dangerous. I used to think those things too. But that is exactly how the investing world is designed to make you feel, so that you give up control of your money to someone else, someone who's an expert, and they'll collect a fat fee for managing your investments for you. I'm going to show you how to take back control of your money, learn to invest for yourself, and outperform the vast majority of professional investors with very little effort. Sounds a bit too good to be true, right? If you don't believe me, then how about Warren Buffett, the 5th richest person in the world, worth a cool $70 billion. He's like the Messi of the investing world. And here's what he said about this investing strategy. The know-nothing investor can actually outperform most investment professionals. The strategy I'm referring to is called index investing. But before we dive into index investing, we need to be clear on what the hell an index is first. An index measures the overall performance of a group of companies. That's it. It's kind of like when you visit the supermarket. You walk around the aisles and you pick up individual items off the shelves. At the end of your trip, you have a basket of different products. An index is just a basket of different companies. The most common example of an index is the S&P 500. The index tracks the performance of the 500 largest companies in the US. There's also the FTSE 100, and this index tracks the 100 largest public companies here in the UK. All right, so that's an index itself, but how can we as individuals invest in an index? Say hello to index funds. Index funds allow you to invest in the performance of a group of companies instead of trying to pick which stocks or individual companies will be winners. By owning shares of an index fund, let's say the S&P 500 index, you now essentially own a tiny sliver of the 500 largest companies in America. Companies tracked in the S&P 500 include Facebook, Google, Netflix, Amazon, JP Morgan, and so on. Therefore, if the S&P 500 goes up 10%, so does your money. If it goes down by 10%, so does your money. Your index fund mirrors the overall performance of that particular index. Index funds are kind of like betting on the World Cup, but instead of trying to pick the winning team of the tournament, which is extremely tough to do, you're able to bet on the top 10 ranked teams in the tournament, which will drastically improve your odds of being right. This strategy reduces the overall time, stress, and the risk of trying to pick individual winners or losers. Index funds are very easy for everyone to buy on their own, making the need to pay professional financial advisors unnecessary. Over the past 90 years, the average annual return of the S&P 500 index has been about 9.8%. So how does the return of an index fund stack up against the pros that you pay to pick the best performing companies? According to CNBC, 2019 marks the 9th consecutive year that index funds actually outperformed the majority of active fund managers, aka professional stock pickers. Nearly 65% of them could not beat the return of the S&P 500. And if you look across a longer period of time, the results are even scarier. Over a 15-year period, 92% of professional money managers could not beat index returns. If you increase that horizon to 30 years, less than 1% of professionals can beat the returns of index funds. So it begs the question, what are we paying these professionals for? If you want me to create a video to show you exactly how paying expensive management fees can cost you hundreds of thousands of dollars or pounds in your lifetime, just let me know at the poll at the top of this video. Remember Warren Buffett from earlier, the best investor in history? Well, in 2007, he issued a bet to the whole hedge fund industry, saying they could not beat the returns of the S&P 500 over a 10-year period. He wagered $1 million betting that if he invested in just index funds for 10 years, he would make more money than the hedge fund professionals. Let's see who was right. As you can see, Buffett was a clear winner. In a 10-year period, he increased his money by 85% through index investing compared to a dismal 22% average return of 5 different hedge funds who picked stocks. Buffett doesn't necessarily have anything against stock picking if you have the time, the knowledge, the desire, and the discipline to do it properly. However, the majority of people don't, which is why Buffett has said that index investments are the best investments that most Americans can make. If index funds are good enough for the best investor in history, they're good enough for me. Index funds are really powerful for 3 main reasons. Number 1, historically index funds give you a really healthy return on your money. Number 2 is they are diversified. So what does diversified actually mean? It means that you are investing in hundreds of companies versus just picking 1 or 2. Imagine you picked 2 stocks, say Amazon and Netflix, and they both lost 50% of their value. You'd be down 50% in your investments. But with an index fund, Netflix and Amazon are just 2 out of hundreds of companies. Sticking with that same example, say Amazon and Netflix went down 50%, but Microsoft and Apple went up 50%, you net out at 0, so your money isn't really impacted. That is called spreading the risk, and that is the benefit of diversification. Number 3, index funds need very little maintenance and take minimal effort to monitor. Personally, I'm a really lazy investor. I don't want to spend my life researching companies, reading balance sheets, and stressing every day if I risk my financial future by picking the wrong companies. I want my money to work hard for me, give me the best returns possible with the least amount of work. Index funds do exactly that. The trap that most beginner investors fall into is that they don't want to wait for their money to grow. People are so desperate to double, triple, or 10x their money that they make risky decisions and bet on companies that they think can make them rich overnight. Hence, the cryptocurrency craze. They lack patience. The truth is that the average returns of 9.8% every year are actually pretty good, as we saw in the study earlier. Good investing is boring. It's like watching paint dry or grass grow. If you want excitement, take $1,000 and go make it rain in Vegas. If you want to learn how to invest on your own, get in touch with me at patrickvenn.com and book in a free 30-minute session. All the details are in the description below. Remember to smash that subscribe button and ring that bell so that you don't miss out on content every single week. Once again, thank you so much for watching, and I'll see you in the next video.